A very good morning to you and welcome to the Rwanda Monetary Policy Committee meeting, the first of 2025, which is set to convene anytime from now to review economic developments and also set the central bank rate for the first quarter of 2025. And the meeting comes amid global economic uncertainties, inflationary pressures, and also shifting monetary policies. And analysts and policymakers are closely watching key indicators such as inflation, GDP growth, and financial risks such as Rwanda navigates the evolving economic landscape. And we also have our team on ground and we'll be crossing over shortly. Let us now cross over to Derek Mohanji, a producer and a reporter with CNBC Africa. Derek, maybe take it away.
Good morning, Tabitha. We are coming to you live from the Central Bank of Rwanda, commonly known to many as Benel, and I will be listening in on the conversations later on here to understand what... Yes? Pardon? I can't hear you.
All right, and as Derek prepares on that, let us now cross over to the Governor General Gomba, who has just stepped in.
On the monetary policy side, we normally start by looking at the performance of the global economy. Again, I won't take much time on this because we've already seen it. These are publications by the IMF. But what we see, global economy remains, let me say, stagnant for 3 consecutive years and expected to stay the same for the next, this year, next year, 3.3, 3.2. This slow growth, recovering from the challenges we had in the last 4 years, the shock from COVID, shock from the high global inflation, 22, 23. But the good thing to note is that as we move to the next slide, is that inflation is easing across the world based on the monetary policy decisions taken by different central banks, 22, 23, tightening their monetary policy stance, but also the opening up of the global trade routes, logistical routes, that has helped to ease the challenges of the flow of goods across the world. And again, as we said, the shock from the Ukraine-Russia war, countries have found, or the world has found ways around that. And so all that has worked to ease global inflation to 5.7 last year, expected to be around 4.2 this year, and further down to 3.5 next year. As you remember, it had gone above 8% in 2022. Same with Sub-Saharan Africa, we see eased inflation again, and as all this has impact on our own domestic inflation. So on the domestic front, I'll start with the general performance of the economy. As you had publication by the Institute of Statistics, the first 3 quarters of this year, the economic growth was strong, at an average of 9.2 so far for the first 3 quarters of this year. This was mainly driven by continued growth in services and industry. Industry, mainly construction, manufacturing, but we also see mining picking up. Again, this year, last year we had strong agricultural growth, especially season A. That contributed to the overall higher economic growth we saw in the first 3 quarters. When you look at the composite index, stay on that slide. When you look at the composite index of economic activity that we track as a central bank, it indicates that 4th quarter growth remains strong. This is at 15.7%, the composite index, not the actual growth. The actual growth should be announced by the Institute of Statistics. Normally it happens in March, but we expect this to remain strong, and most likely the original projection of 8.3 growth for 2024 will be exceeded. On the trade or external sector, we see improvement of our numbers in fourth quarter of 2024. Increased export at 15.8%, still growth in imports, though much lower than what we experienced in exports, and this had a positive impact on the trade deficit that was reduced by 3.7% in the fourth quarter. But overall, for the year January-December 2024, growth for exports were at 6.9%, imports at 5.8%. But as I always say, because the base of imports is much bigger, we saw our trade deficit widening by 5.2%. So this had an impact on our exchange market, where we saw the flour rwanda depreciating by 9.42 in 2024. This is much lower than the 18.05 we registered in 2023, but still higher than our normal average of around 5%. On the transmission mechanism, we track the movements in interest rates of the interbank market rates and government securities rates, but also the lending and deposit rates. So as we always say, the short-term money market rates always follow our policy decisions. As you can see, the interbank rate reduced to 6.7% on average in quarter 4, compared to 8.27 where it was in quarter 4 of 2023. This was mainly linked to our easing of the monetary policy stance in May and August of last year. We haven't seen much transmission into the lending and the deposit rates, so it takes time. It takes time for these monetary policy decisions to be to influence the longer term interest rates. So more or less remaining the same over the last 1 year compared to the year before. So our main focus is inflation. So 2024 was a good year in terms of inflation. We saw prices or the speed at which prices were increasing really reduced, and inflation stayed in our band from the beginning of the year to the end of the year. As you can see, in fact, from the end of last year of 2023, which it has reduced to 4.1%, and as we had explained in the last MPC sessions, this was mainly driven by good performance of agriculture in season A of 2024, and the normalization of global trade and the reduction of global inflation, as well, as I had said earlier. So as you can see, at the end of the year, the last quarter of last year, inflation was at 5.2%, slightly higher than the rest of the year, and this was because of unfavorable weather conditions that delayed agricultural produce, but also affected overall agriculture in season A. And we are comparing season A to a season A of 2023 that was bumper harvest. So we wouldn't say that the harvest for season A 2024 was that bad, but when you compare it to the bumper harvest we saw in 2023, so the price slightly moves upwards because of the base effect. And that is explained in the details on the right-hand side of the slide, showing the different categories of our inflation. The big jump, as I said, is in food, mainly because of the base effect, because of very low prices we experienced in end of 2023 and beginning of 2024. So this shows the quarterly movement of inflation to the end of the year. And for January, again, as you see in the publications from the Institute of Statistics, inflation was at 7.4%. Mainly linked to food prices again, the base effect, because the yields for the first quarter of this year was below the yield we received in 2023. So going forward, the inflation outlook is that for this year, 2025, we project that inflation will remain within our band. But as if you remember, in the last MPC round, we had projected it to be at 5.8%. We have revised that slightly higher to 6.5% based on the numbers we got for the last year and so far where we are by end of Jan and the projections we see ahead. So this is expected to average 6.5% this year and move down 4.1% next year. This is assuming normal agriculture performance for season B 2025 and normal agriculture performance over 2026. So again, as you see, the risk we always highlight is these projections are based on normal weather condition and normal agriculture performance, but also we see geopolitical tensions globally in the region. So this doesn't take into consideration any effect from these tensions we see around. So if we don't expect any of this to materialize to the extent of affecting our inflation projections, but remains a risk that we are monitoring. So with that, the Monetary Policy Committee has decided to maintain the policy rate at 6.5%, though there are slight pressures on inflation, but remains within the band. And we are confident that at this rate, 6.5%, we'll be able to maintain the inflation within the policy band of 2 to 8% over the medium term or over the policy horizon, as we normally say. So that's the summary of the outcome of the discussions we had in the Monetary Policy Committee. On the Financial Stability Committee, we start by looking at the overall deepening of the financial sector. It continues really to deepen. The assets growing by 20.6% to 12.8 trillion. And this translates into 68.5% of our economy. So when you look at that 5-year horizon, we had a blip in 2021 because the economy had really shrunk in 2020 because of COVID. But looking at from 2022, the financial sector vis-a-vis the economy started recovering, and it remains strong. It remains strong in terms of its deepening, but also financing the economy in general. And this is seen across all the subsectors of the financial sector. So the slide here shows the growth of the assets of the banking industry and the microfinance institutions. As we had indicated in the last MPC round, the microfinance institutions registered very high growth last year because of the shift of 3 formerly microfinance banks to the category of microfinance institutions. So that influenced the higher growth of 39.4% of the assets of the subsector that we see here. But generally speaking, it remains positive across all the subsectors. Here we are looking at the intermediation. Both banks and microfinance institutions continue to increase their lending to the private sector. So the outstanding credit to the private sector continue to increase. But also the new loans to the private sector, when we look at last year, growth of 16% from the banking industry. So this is positive. It remains. We'll be looking at the stability numbers, but at least on the growth numbers, on the impact of the financial sector, the banking industry, and microfinance institutions on the performance of the economy, we see it remains positive and strong. So on the stability numbers, here we look at the banking industry. Again, we are used to these measures: the capital adequacy ratio, the liquidity ratio, and the non-performing loans. So they all remain strong above the regulatory requirements. Capital adequacy ratio at 20.5%, and the main factor here is the non-performing loans remaining below 5% for now. I think this is the 3rd year running, and that indicates positive developments in the underwriting practices and risk management of the financial institutions. and gives confidence on any shock or to the stability of the institutions. But still, the good thing is we have a strong capital base. We have enough liquidity for the banks to meet the obligations, whether short-term or long-term, and profitability continues to increase as well. So profitability helps to reinvest these resources into the financing of the economy and strengthening of the financial sector in general. Same with the microfinance institutions. Strong capital base, non-performing loans continues to decline, staying below 5%. Liquidity ratio is still very high and also improving profitability of the microfinance institutions. Insurance sector, so we saw its assets increasing by 18.5%. This is mainly driven by increase in gross premiums and plowed back resources from retained earnings and investment income as well. On the stability side, the insurance sector also remains sound. If you move to the next slide, please. Yeah, so here we show the solvency ratio that we use to measure the capital base or the capital strength of the insurance sector. This is way high above the minimum requirement, and same with the liquidity, still above the 100% requirement, and also we see profitability increasing in the insurance sector. And on the pension side, now this is a private, yes, on the pension side, whether RSSB, the private pension funds, Ejoheza, we also see the assets increasing. We see increasing contributions and increasing investment income that is keeping this pension sector strong and able to serve the needs of their clients. On the payment system developments, maybe just focusing on when we look at the transaction, the volume, whether person to person, person to business, push and pull, they have all been increasing. So we see deepening of digital financial services. And this is seen on the next slide, where we show the percentage of these digital transactions, value of these digital transactions as a percentage of our GDP that has continued to increase every year, increasing from 179% in 2023 to 301% this year. And we, as again I already say, we expect this to even increase faster going forward as we see eCash coming on board. Just summary to show that beyond the normal prudential measures we track, we see emerging challenges, and we always follow this as a regulator to avoid any shock caused by these emerging issues like climate change, cybersecurity. So we continue to track this, whether through supervision, but also regulation and directives we issue to the financial institutions. So in summary, we said we see the sector really strong and stable, and we expect this to be maintained over the medium term. Again, as a central bank, as a regulator, we continue monitoring all the developments to take any necessary action if there is need to avoid any instability within our financial sector. So briefly, that's what we had from the two committee meetings. As requested, let me try to summarize that in Kinyarwanda. So let's continue to the slides. So murakoze cyane, nk'uko bisanzwe buri gihembwe akanama ka politiki y'ifaranga n'akanama gashinzwe kutajagajega ku rwego rw'imari turaterana. So n'umwanya twaboneyeho gutangaza ibyavuye muri izi nama zombi. Duhereye ku bya politiki y'ifaranga, dutangira tureba ku rwego rw'isi uko ubukungu buhagaze. Ubukungu ku rwego rw'isi bwatangiye kuzaho ukurikije ibibazo twari twagize mu gihe cya covid, ariko bwakomeje buri hasi gato yuko byari bimeze mbere ya covid. Nubwo tubona icyizere yuko mu gihe kiri imbere bizakomeza gutera imbere neza, ariko twebwe ko dukurikiranira hafi nka Banki Nkuru y'Igihugu ni ku bigendanye n'umuvuduko ku biciro ku masoko.